Stop what you're doing for a moment. Addie John here, and you need to pay very close attention to what I'm about to say. This isn't speculation, it isn't a theory, and it's definitely not another dramatic headline designed to harvest clicks. Between February 3rd and February 7th, 2026, regional banks across the Midwest and Southeast processed $47 billion in withdrawal requests. Not over a year, not over a quarter, in just 5 days. That number isn't coming from fringe blogs or conspiracy forums. It's buried inside the Federal Reserve's H8 report, the weekly release detailing assets and liabilities of commercial banks, a document most investors never bother to read. Let's be clear about what this is not. This is not a chaotic bank run, with people lining up outside branches demanding cash. This is not a social media-fueled panic that fades in 48 hours. And this is not a minor liquidity hiccup that disappears once the Fed briefly opens the discount window. What this actually is a quiet, calculated reallocation of deposits by institutional investors, high net worth individuals, and corporate treasury departments who are studying the same balance sheet data I'm about to break down for you. They are shifting money out of regional banks and into money market funds, short-term treasuries, and in many cases, physical assets outside the banking system entirely. The reason you're not seeing this dominate headlines is simple. The outflows are gradual enough to avoid triggering immediate FDIC intervention, but fast enough that by the time average depositors recognize what's happening, many of these banks could already be in emergency merger talks, recapitalization efforts, or outright resolution. And if you believe your deposits are completely safe because of FDIC insurance, you need to understand something that may fundamentally change how you think about financial security. The FDIC Insurance Fund holds roughly $128 billion. Total insured deposits in the United States exceed $10 trillion. That's a coverage ratio of about 1.28%. If just 2% of insured deposits were claimed simultaneously, the fund would be mathematically insolvent. Over the next several minutes, I'm going to walk you through why this withdrawal wave is occurring, what the balance sheet pressure looks like inside these institutions, and most importantly, the 3 strategic moves you need to consider right now to ensure your capital isn't trapped inside a system designed to convert deposits into equity during a resolution event. This is not a rehearsal. The process has already begun. And the window to position yourself is narrowing with every business day. Before we examine the current mechanics, you need to understand how modern bank runs actually unfold. Because the image most people still carry in their minds, Great Depression-era photos of crowds outside banks, is completely outdated. Modern bank runs are digital. They happen electronically, and they move in stages that most depositors don't recognize until the final phase, when the bank is already in receivership. The structure is what I call the silent withdrawal cascade, and it unfolds in 3 distinct phases. Phase 1 is institutional repositioning. Large depositors, corporate treasury departments, pension funds, and family offices begin shifting funds in amounts large enough to trigger internal reporting, but not yet large enough to force public regulatory disclosure. These transactions are quiet, fragmented, and framed as normal cash management. Banks categorize them as routine deposit fluctuations. Phase 2 is acceleration. After the first wave of institutional withdrawals, banks must start liquidating assets to meet redemption requests. Many of those assets, particularly long-duration securities purchased in the low-rate era, are currently underwater due to the interest rate environment since 2022. Selling them crystallizes losses on the balance sheet. When quarterly earnings reveal those realized losses, a second wave of more informed depositors begins withdrawing funds. Phase 3 is public awareness. Regional media picks up the story. Social media amplifies concerns. Retail depositors react. But by that stage, the bank is already in active discussions with regulators about emergency liquidity, mergers, or orderly liquidation. If you're a depositor at that point, you're no longer protecting capital proactively. You're hoping the FDIC process unfolds smoothly and that uninsured funds are eventually recovered, a process that can take months or even years. Here's the core thesis. We are currently in phase 2 of a withdrawal cascade affecting regional banks with heavy exposure to commercial real estate, long-duration securities, and depositor bases skewed toward institutional rather than retail clients. The drivers are mathematical, not emotional. These banks hold assets that have declined in market value by 15% to 30%, while deposit liabilities remain at par. That difference represents a solvency gap masked by accounting rules that allow securities to be carried at amortized cost instead of mark to market. But when depositors withdraw funds and securities must be sold, the accounting fiction ends. Losses become realized. The asymmetry is clear. Informed depositors move early before the public phase. Uninformed depositors wait for confirmation that only arrives after their flexibility has disappeared. That timing difference determines who preserves wealth and who doesn't. To understand how this unfolds, look at history. This pattern has played out before with remarkable consistency. The first example is the banking panic of 1930 to 1933. Most people focus on the 1929 stock market crash, but the real systemic damage occurred in the banking sector over the next 3 years. More than 9,000 banks failed in the United States. The mechanism was identical. Banks had expanded aggressively during the 1920s, particularly in real estate and agricultural lending. When asset values collapsed and borrowers defaulted, banks were left holding collateral worth far less than outstanding loan balances. As concerns about solvency spread, depositors withdrew funds. Banks were forced to liquidate assets at distressed prices, losses mounted, withdrawals accelerated. The cascade intensified until the banking system effectively froze. The depositors who lost everything were those who waited. They believed their bank was stable. They trusted their relationships. They assumed government protection would arrive in time. By the time they acted, the doors were closed. Those who preserved wealth acted early. They withdrew cash. They moved to stronger institutions. Many converted deposits into gold before Executive Order 6102 restricted private gold ownership in 1933. The lesson isn't that every bank fails. The lesson is that in a cascading withdrawal environment, timing is decisive. Once the public phase begins, optionality disappears. The second historical parallel is the savings and loan crisis of the 1980s and early 1990s. During the 1970s, savings and loan institutions issued long-term fixed-rate mortgages at 5% to 7%. When Paul Volcker raised the federal funds rate to nearly 20% in 1981 to combat inflation, those institutions were trapped. They paid depositors double-digit interest to retain funds while earning far less on their mortgage portfolios. The mismatch was fatal. More than 1,000 institutions failed. The Resolution Trust Corporation was created to liquidate assets. The ultimate taxpayer cost exceeded $130 billion, but here's the key insight. The institutions that collapsed first were those that experienced early deposit withdrawals. Once funds began leaving, forced asset sales exposed balance sheet insolvency. That visibility triggered further withdrawals. Informed depositors moved into money market funds or Treasury securities and avoided losses. Uninformed depositors endured years of claims processes. Interest rate mismatches create solvency problems, and solvency problems cannot be fixed by temporary liquidity facilities. They require recapitalization, merger, or liquidation. Now connect that framework to February 2026. According to the Federal Reserve's H8 data, commercial banks reduced total deposit liabilities by $47 billion in the week ending February 7th. Deposit fluctuations happen regularly. But when you examine the composition, the concern becomes clear. The largest declines occurred in large-time deposits, balances above $250,000, and in transaction accounts at domestically chartered banks outside the top 25 largest institutions. In plain terms, institutional clients are withdrawing funds from regional and community banks. And they're not doing it randomly, they're doing it as risk mitigation. Why now? Because of what's happening on the asset side of balance sheets. During the zero-rate period from 2008 to 2021, regional banks accumulated massive portfolios of long-duration mortgage-backed securities and treasury bonds to earn incremental yield. When rates surged from near zero to above 5% in roughly 18 months, the market value of those securities fell sharply. A 10-year treasury issued at a 2% coupon is now trading around 85 cents on the dollar in a 4.5% yield environment. Mortgage-backed securities issued at 3% are even more discounted. Banks can avoid recognizing those losses if securities are classified as held to maturity, but the losses exist economically. If depositors withdraw funds, banks must either borrow against those securities at the Fed's facilities or sell them and realize losses immediately. We saw this exact dynamic in early 2023 when Silicon Valley Bank experienced $42 billion in outflows in one day. Forced asset sales produced a $1.8 billion realized loss. Within 48 hours, additional withdrawals surged electronically. The bank entered FDIC receivership. That run happened digitally. Retail depositors learned about it after the institution was already closed. What we're seeing now is a distributed version of that dynamic, slower, quieter, spread across multiple regional institutions. The $47 billion withdrawal represents roughly 1.2% of deposits at regional banks outside the top 25. That might sound small, but velocity matters. If that pace continues for a month, deposits fall by roughly 5%. At that level, banks must begin liquidating securities portfolios. Once realized losses appear in earnings reports, the next wave accelerates. The cascade doesn't need panic to move, it only needs math. And math is already in motion. Now let's talk about the silent mechanism that makes this very different from old-fashioned bank runs, and why most depositors are dangerously misinformed. After the 2008 financial crisis, the legal framework governing bank failures changed. Title II of the Dodd-Frank Act, passed in 2010, gave the FDIC authority to place systemically important institutions into a resolution process called orderly liquidation authority. Hidden inside this framework is something called the bail-in. Here's how it works. When a bank enters receivership, the FDIC takes control. Shareholders are wiped out immediately. Bondholders, people who lent money by buying corporate debt, take a haircut. Their bonds are converted to equity at a steep discount or written down. Then, if additional capital is needed, uninsured deposits, any amount over the $250,000 FDIC insurance limit, can also be converted into equity in a bridge bank or restructured entity. This is not theoretical. In 2013, the Bank of Cyprus used this mechanism. Depositors with balances over $100,000 lost up to 47.5% of their deposits, converted into equity worth far less than their original cash. Many never fully recovered. The same framework exists in the US, EU, and UK, meaning any deposits above the insurance limit are at real risk in a resolution scenario. That's why institutional depositors are moving money now, before the resolution process begins. They're not waiting to see if their bank will be one of the lucky ones acquired by a stronger institution. They're eliminating risk entirely, moving to too-big-to-fail banks or into Treasury securities with zero credit risk. Consider the 2023 seizure of First Republic Bank. It had $104 billion in deposits, of which $90 billion were uninsured. Depositors were protected only because JP Morgan stepped in to acquire the bank. That was an exceptional case. If multiple regional banks enter resolution simultaneously, there won't be enough buyers to assume all deposits. That's when the bail-in mechanism becomes the primary resolution method, and uninsured depositors take the hit. So what do? Let's break down 3 asymmetric moves that can protect your wealth right now. Move 1. Immediate deposit reallocation. If any of your accounts exceed $250,000, move that money this week. Don't wait. Split deposits across multiple banks to remain fully insured. Use Treasury-backed money market funds or short-term Treasury bills purchased through Treasury Direct or a brokerage account. The math here is shocking. The risk of leaving money in an uninsured regional bank could be a 50-100% loss in a resolution event. Moving now costs almost nothing. The interest rate trade-off is negligible, often just 0.1–0.2%, but it eliminates catastrophic risk. Business owners need to map all accounts immediately. Every account above the FDIC limit is a vulnerability. The cost of inaction is catastrophic. The cost of action is nearly zero. Move 2. Position in physical precious metals. Gold and silver are the only assets completely outside the banking system. They carry zero counterparty risk and have historically preserved purchasing power during banking crises. Gold is trading near 2,700 OZ, silver around 31 Oz. These levels are high relative to history but still well below past peaks in real terms. In a banking crisis, physical metals are the ultimate liquidity. No bank, no regulator, no government can turn them into equity or seize them. Allocation should be significant, 10 to 20% of liquid net worth minimum, 30% if you understand the systemic risk fully. Buy reputable bars or coins. Avoid collectibles with huge premiums. Store them at home or in segregated allocated vaults like Brinks or Loomis. History proves the point. During the 1930s, gold went from $20.67 Oz to 35 Oz, a 69% gain, as the banking system froze. During the 1970s stagflation, gold surged from $35 to over $800 Oz, a 2,200% gain, as confidence in fiat collapsed. Gold and silver are insurance against systemic collapse, not speculation. Move 3. Build exposure to senior secured distressed credit. This is a more advanced play, but offers enormous asymmetry. As banks sell assets to raise cash, distressed commercial loans, middle market corporate loans, and asset-backed securities will hit the market at steep discounts. Senior secured debt gives you first claim on collateral. Even in bankruptcy, you're first in line. Opportunities include closed-end funds and business development companies specializing in distressed credit. Look for discounts before the public realizes the value. Top managers in this space include Oaktree Capital, Apollo Global Management, and Ares Management. These firms made billions in 2008 buying distressed loans from forced sellers. Today, the setup is strikingly similar. Signals the cascade is accelerating. Bank Term Funding Program utilization increased $12 billion in the first week of February 2026. Banks are borrowing against underwater securities to avoid realizing losses. Spread between Fed funds rate and savings account rates widened to 180 basis points. Banks are desperate to retain deposits. Commercial real estate loan delinquencies at regional banks hit 7.2%, the highest since 2012. With CRE loans often 30 to 40% of regional bank portfolios, any spike in defaults quickly erodes capital. These are the same early warning indicators that preceded 2008 bank failures and the 1980s S&L crisis. Why isn't mainstream media covering this? 2 reasons. The withdrawal process is gradual. $47 billion over a week is huge to those who understand balance sheets, but not headline-worthy. Media reacts to panic outside branches, not quiet institutional moves. There's a vested interest in maintaining confidence. Regulators, banks, and policymakers know public panic accelerates the cascade, so communications are framed as temporary fluctuations with FDIC insurance emphasized. The result? Retail depositors remain unaware until the damage is done. Institutional players already moved. This is exactly what happened with Silicon Valley Bank in March 2023. Insiders started shifting funds Thursday. By Friday, the bank was in receivership. Retail depositors had no warning. The asymmetry isn't luck. It's access to information and the willingness to act before it feels comfortable. Now here's my question for you. Do you currently have deposits above $250,000 in a regional or community bank? Are you planning to reallocate them immediately, or are you waiting to see what happens? Your decisions over the next 2 weeks will determine whether you act ahead of this cascade or get caught in it. If this analysis hits home, do 2 things immediately. Subscribe and turn on notifications. I'm tracking this data weekly and will update as the situation unfolds. This isn't entertainment. This is real-time wealth protection. Share this information with anyone you know with significant deposits in regional banks or who runs a business with operating cash accounts. They aren't going to be warned before it's too late. The withdrawal cascade is already in motion. The mechanics are mathematical, not emotional. Informed depositors are moving now. Uninformed depositors are waiting. The question is simple. Which side are you on?